IFRS 9 Core Components of Expected Credit Loss. Welcome to Lecture 2 of the IFRS 9 crash course. In this session, we'll look at the three core building blocks of the expected credit loss model: probability of default, loss given default, and exposure at default. Expected credit loss, or ECL, is a forward-looking measure. It requires financial institutions to estimate potential losses before they occur, based on both historical data and future forecasts. The formula that drives ECL is simple in theory: PD multiplied by LGD multiplied by EAD. First, probability of default, or PD. This represents the likelihood that a borrower will fail to meet their obligations. Under IFRS 9, we use two types of PD: the 12-month PD used for Stage 1 assets, and the lifetime PD used for Stage 2 and Stage 3 assets. PD must always incorporate forward-looking information, such as macroeconomic scenarios. Second, loss given default, or LGD. This measures how severe the loss will be if default occurs. LGD depends on factors like collateral, recovery processes, and the seniority of debt. For example, a mortgage secured by property will usually have a lower LGD than an unsecured credit card loan. Third, exposure at default, or EAD. This is the amount outstanding at the time of default. It includes the principal balance, interest, fees, and even expected future drawings on facilities such as credit cards. When combined, PD, LGD, and EAD give us the expected loss. For example, if a loan has a 5% PD, a 40% LGD, and an exposure of £100,000, then the ECL is £2,000. To summarize, PD tells us the likelihood of default, LGD tells us the severity of loss, and EAD tells us the amount at risk. Together, they form the foundation of every IFRS 9 credit loss model. In the next lecture, we'll explore which financial instruments fall within the scope of IFRS 9.